Hello everyone. Today we will be doing accounting's homework for the first official class. And let's begin. So the first one, we are given a list of different roles, and then these are their responsibilities, and we're just going to match them, and I'm going to decide if they are internal or external. Let's begin. The first one, deciding whether the company pays the fair salaries. It's okay. It is very obvious that this is going to be the labor union. They try to protect the right of the workers. Yeah, I'm just going to write an acronym to save some time. And second one, decide whether the company can pay its obligation. Creditor. And decide whether a marketing proposal will be cost effective. Oh, okay, marketing. Of course, you need to looking for the marketing manager. So, MM. And deciding whether the company's profit will permit an increase in drawings. I think this one is a little bit strange, but I guess based on the list we have, I think the owner will be the most proper choice. And the last one, decide how the company should finance its operation. Well, based on the choice we already have, and whatever left should be the correct answer. Chief Financial Officer, CFO. And yeah, it seems to work. And let's go to the next one, 1-2. Okay, match the following business type. We have proprietorship, partnership, corporation. First one, shared control, combined skills and resources. So this should be a partnership, P. And easier to transfer the ownership and raise funds, no personal liabilities. Okay, this is a corporation. And the last one, simple to set up, owners pay the debt. This is going to be the proprietorship. And let's go to the next one. Describe an ethical dilemma that each of the following individual might encounter. I think, yeah, it's just whatever it is. If it makes some sense, I guess you just get a mark. So it doesn't matter, and I will show my example. A student, yeah, I think the biggest problem for students is they might try to cheat and get a good mark. That's an ethical dilemma. And then for production supervisor, yeah, since his salary may get some bonus based on the production skills, and he may allow some defective products to get shifted, and that's a perfect example. And the last one, a banker. So he might maybe try to give the customer some false information and try to get their services, even though they don't technically satisfy the conditions to apply for the service, but they just give it anyway. So give unnecessary service. And And yeah, let's go to 1-4. Okay, so 1-4. Okay, so this is about the definition of the terms, which is very boring, and I just going to quickly explain. If a choice is false, I just quickly go through why this is wrong. So relevance is an enhancing qualitative characteristic, and this should be fundamental, not enhancing. So the first one is false. Okay, false. And timeliness is enhanced when a business uses the same accounting method from year to years. I think it has nothing to do with timeliness. Its timeliness is the financial information being delivered in a quickly manner. It passed to its different users before it loses its value. Let's say a report of the company is if it is delivered too late, and the company is going to change within that deliver period, right? So the situation changes, and that's what is timeliness all about. And this is false. And C, understandability is an enhancing qualitative characteristic that requires accounting information to be clear and concise. That's true. Information is verifiable if two independent people they use similar method and get a similar result. That's true. And last one, information is neutral when it is unbiased. Obvious. True. And we will keep moving on. Let's keep going. And sorry, 1-5. Determine if the following statements are true or false. Canadian publicly accountable enterprise have a choice to report under IFRS or ASPE. This one is obvious. It's wrong because this is a public accountable enterprise. You cannot follow the standard of a private company. All private enterprise must follow ASPE. And I think it's also false because they get a choice to choose between IFRS or ASPE. They get a choice. It's not necessary all of them follow the same rule. And the companies are required to include a note to saying that to say what kind of financial standards they are using. True. And using IFRS may help Canadian public company to attract investors from around the globe. True. True. And matching problems. We got different GAAP rules, principles. The first one, transactions are recorded in terms of units of money. That's going to be the monetary unit concept. Yeah, everything recorded there has some kind of values in terms of money. And number 2, transactions are recorded based on the actual amount received or paid. Historical cost, or maybe you can call this the matching principle, indicates that the personal and the business record keeping should be separated. This one is going to be the reporting entity concept. it says that anything that's not relevant to the company, it should not be appear on the financial statement. And performance obligation has been satisfied. Okay, that's revenue recognition. And last one, business are expected to continue operating indefinitely. This one is called going concern assumption. It's the company is just keep running. It will not stop no matter what. It's a strange assumption, but it's just how it is.
Interim.
Okay. Yeah, let's keep going. Okay. 1-7, we got different category and we will match their description. The increase in assets or decrease in liability resulting from business activities carried out to earn profits. So basically you are offering a service or something and you earn some money from this. This is going to be revenue. And resources controlled by a business that are expected to provide future economic benefits. Okay, assets, you can use it to produce more goods or resell it to try to make a profit. And yeah, it is the asset. And let's go for the next one. The owner's claim on the residual assets of the company. So basically, yeah, how much money inside the company is yours, is truly yours. That's going to be the owner's equity. And D, present obligation which are expected to result in an outflow of economic resources as a result of past transaction. So basically you have to pay someone money. It's going to be the debt. That's going to be liabilities. E, the cost of the resources consumed or service used in the company's business activities. So you are spending things to operate your business. So it's going to be expense. Yeah, you are using things up in order to run your business. And 1-8, this is the calculation problem. It should be very straightforward. Remember, the accounting equation asset equals to liability plus owner's equity. Yes. And just follow this formula and get the unknown value. So let's take a look at the first one. We know the asset and liability. We just subtract this from this. So the first problem is going to be 51000. And second one, we know the liability and the owner's equity, so we add them together. And we will get 241,000. And C, we know the assets and owner's equity. We just subtract the owner's equity from the asset. And whatever we have left is the liability. So we get $37,000. Yeah. And let's move on to the next one. So it's still calculation. So the liability of this company is $120,000 and the owner's equity is this amount, and we just add them together to get the asset. So this is going to be 352,000. And next one, the total assets of King's company is this amount. and this is the owner's equity, so we just subtract and we get $99,000 for the total liability. And C, we get a total asset, and the liability is equal to half of its total asset. And what is the amount of the company's owner's equity? So half of this is the liability, and the other half must be the owner's equity. So it should be $200,000 of equity. And yeah, the liability and owner's equity in this case is just half and half, dividing the asset. And let's go to the 1-10. Okay, Buttery Company is owned by this guy, and the company has total asset of this and total liability of this at the beginning of the year. So before we actually start the problem, let's just state the beginning asset, liability, and owner's equity. So asset is $850 and liability is $550,000, and the equity, it should be owner's equity, it should be $300,000. Yeah, this is the beginning amount. And let's see what happens during the year. So during the year, the total asset is increased by this amount, and total liability is decreased by this amount. So what is the amount of the owner's equity by the end of the year? So A, we know that asset is increased by this amount. Now we have $980,000 of asset, and the liability decreased by this, which means now we have $470,000 of the liability, and whatever left is the owner's equity. So it's $510,000 here. And we solved the first problem. Let's take a look at the next case. And let me just quickly transfer the beginning amount to the next pages. Liability. So the total liability is decreased by this amount during the year, and the company incurred a loss of $40,000, and he made an extra $100,000 of investment and no withdrawals. What is the amount of total asset? So we know that the new liability is decreased by this amount, and we can get a new liability amount, which should be $455,000. This is the new liability, and the company incurs a loss in $40,000 and another $100,000 of investment. Therefore, the owner's equity is increased by $60,000. So the new owner's equity should be $360,000. and it will give you the new total assets by adding this two amount, and it should be 815,000. Let me just quickly check the answer if I get it right or not. Yeah, we are doing good. And C. Let's take a look at the C. So the total assets is increased by $45,000, and the total liability decreased by this. There are no addition owner's investment, but he withdrew $40,000. Okay. What is the amount of profit or loss in the year? Okay, so we know that the new assets is increased by this amount, which gives us 95,000, and the liability is decreased by this. Now we have so many liabilities, and we can calculate the owner's equity here. It's going to be $395,000. This is the new owner's equity compared to this. So it increased by $95,000. We know that it withdrew $40,000, and there is some profits during the year. So minus 40,000 plus the change of the years, we can clearly see that the company is making a profit of $135,000, and this is going to be the profit of the company in the year. And yeah, I think it has been a very long video so far, and maybe we'll continue in the next video, and we'll do a part 2. So just bye for now and stay in tuned. Bye.